Welcome to the Investors Podcast. I'm your host, Trey Lockerbie, and today I'm so excited to have my friend Richard Duncan back on the show. Richard, welcome back.
Thanks, Trey. It's great to be back.
I've been dying to catch up with you because the last time you were on our show was episode 401. It was back in July of 2021, and things have really gotten interesting since then. At the time, we were kind of positing that inflation had peaked. Now, inflation, we've actually seen higher prints since then. So I wanted to get your take on maybe why that is. I know you had a long time horizon for that comment, so don't get me wrong, but are we peaking now? Has it peaked? What does the economy look like since July?
Okay, so you're right. The inflation rate has moved up, certainly much more than the Fed or I had expected. The reason inflation's been dropping since the early 1980s is because of globalization. Up until 1980, the U.S. didn't run a trade deficit. But starting in the mid-1980s, the U.S. started running an extraordinarily large U.S. trade deficit for the first time in history. Because when money had to be backed by gold, as was the case up until 1971, trade between countries had to balance. Because if a country had a big trade deficit, before then it would have to pay with its gold. And it only had a limited amount of gold. So it would have run out of gold. In other words, it would have run out of money and its economy would have collapsed. So trade had to balance. Starting after Bretton Woods broke down in 71, it didn't take the U.S. long to realize that it could run very big trade deficits, and it didn't have to pay with gold anymore. It could just pay with paper dollars or treasury bonds denominated in paper dollars. So by the middle of the 80s, the U.S. trade deficit was 3.5% of GDP. And by 2006, it was 6% of GDP. And so despite the extraordinarily large budget deficits that President Reagan ran in the 1980s, and later on even larger budget deficits, and despite all the money that the Fed was creating right through the crisis of 2008 up until 2014, we didn't have any inflation. The money supply growth, which reflects the amount of money that the Fed creates, it peaked at something like 150% year-on-year growth in 2011. So you would have thought that would have caused hyperinflation. If money supply growth causes inflation, then that kind of surge in the money supply growth, which resulted from the Fed's 3 rounds of quantitative easing, well, that should have done it. But the inflation rate peaked at 3.9% in 2011. And then by 2015, we had deflation again. Prices were falling in early 2015. So what's going on now? The increase in the money supply is less than half of what it was in 2009. But now the most recent number for the inflation rate is 7.1% year on year. So what has changed? Well, what has changed is because of COVID, what we're seeing is a partial breakdown of globalization. Globalization is the reason we didn't, meaning these big trade deficits. Once the U.S. started running large trade deficits, especially with low-wage countries, that put extreme downward pressure on prices in the U.S. So we had deflation and we even flirted with inflation since we were buying so many goods from countries whose workers made less than $10 a day. So it was globalization that explains why we've had very low rates of inflation in recent decades, despite the massive budget deficits and the massive money creation by the Fed. But what we're seeing now, because of COVID, is a partial breakdown of globalization. We have extreme global supply chain bottlenecks causing inflationary pressures on things like semiconductors especially. But we're also seeing domestic disruptions in the U.S. as millions of people have left the workforce because they're afraid of catching COVID. So what we're seeing is higher rates of inflation now because globalization has partially broken down. Now, presumably, this isn't going to last forever. It may. COVID may go on year after year. It could become much worse. There could be a massive wave of COVID infections across China. China has a zero COVID tolerance. So that could force China to shut down all its major industrial centers. In that case, we would see much higher rates of inflation. But if we go back to a period where, similar to what we were experiencing for decades before COVID started, then we'll once again see that globalization puts extreme downward pressure on prices. And we'll probably soon be flirting with deflation again, the way we were up until the time COVID started. Now, it is true that the inflation rate is certainly higher than the Fed has expected. But let's take a look at that. The CPI, the Consumer Price Index, It is an index. It's a series of numbers. And the December number was 7.1% higher than it was in December 2020. But it was only 8.5% higher than it was in December 2019. So the 2-year average for inflation is just 4.3%. That should be taken into consideration because in 2020, there was actually deflation in the United States during the second quarter. Prices were falling. So 7.1 sounds like a very high rate of inflation. As people like to point out, it's the highest in 40 years. But if you take the 2-year average, which incorporates the deflation the year before, we're looking at 4.3%, which is similar to what we had as recently in 2008, before the crisis of 2008 started. So the hype about inflation, okay, there is prices are going up, but this is far cry from hyperinflation. And chances are, before long, they will start going back down again. For instance, in the second quarter of last year, used car prices went up 40% year on year, and that accounted for 1/3 of all of the inflation during that quarter. Pretty soon, we're going to have plenty of semiconductors again. New car prices are going to be down. Used car prices are going to fall by 40%, and that will take a whole lot off the inflation number when that occurs. So before long, we'll be experiencing disinflationary pressures again, and perhaps even deflationary pressures, as we were before, because we have a global economy now with probably, let's just say, hundreds of millions of people willing to work for less than $5 a day. And that's extremely deflationary. And assuming that globalization doesn't break down permanently, then those forces that prevented inflation before COVID will exert themselves again, and we'll be back in a very low inflationary environment before long.
As you were saying that, something occurred to me for the first time, which is this idea that globalization and the US reserve currency kind of go hand in hand. So when you're saying globalization, how much of that is also the fact that the US dollar just needs to get out there into the world because we're running these huge deficits, which in itself can be somewhat deflationary?
Those things are all tied together. Because China wants to sell things to the United States, they ship their goods to the United States and they sell them in dollars. And so they take their dollars back to China. And that's why China has so many dollars. The US trade deficit, which is going to hit a record high this year of close to the trade deficit in goods meant last year. We don't have the December number yet for 2021, but the trade deficit in goods will be an all-time record high, more than $1 trillion in 2021. So what that means is that foreign companies will sell their goods in the US and their surplus will be $1 trillion that they will take back to their countries. And that throws off an extra $1 trillion into the global economy. The trade deficit is the reason why there are so many dollars in the world. And this is not going to end anytime soon because the US is going to continue to have a very large trade deficit far into the future, as it has now since the early 1980s. And the US trade deficit, which has probably been, off the top of my head, in the range of $10 to $12 trillion since it started in 1980, that's made the rest of the world grow by not just $10 to $12 trillion more than it would have, but there's been a big multiplier effect. As those dollars have gone into the banking systems of other countries, that's allowed credit creation through the system of fractional reserve banking that's transformed the world. These dollars that have gone into China's banking system, that's the reason China's been transformed from a very poor third world country when I first saw it in 1986 to the point where Shanghai now looks like the Emerald City in the Wizard of Oz, with infrastructure across China that's far better than the United States. And why China is now threatening, and it's one of the reasons China's used this money wisely, invested it. And that's one of the reasons that China is about to overtake the United States and become the dominant global superpower, unless the United States takes radical action immediately to ensure that doesn't happen.
So I don't put a whole lot of weight into the CPI numbers personally, but there are things I'm seeing that are taking off, not only asset appreciation, but wage inflation is something that is, I think, much more prominent in the US, at least since we last spoke. How much do you follow things like wage inflation, this thing with the Great Resignation and labor shortages and employment being low? I mean, what is this all telling us about where we are in the economy today?
I think what it's telling us is that the number of people in the workforce, even though the unemployment rate has come down very quickly and very sharply, it peaked at 14.8% in April 2020. Now it's down to 4%. So a lot of jobs have been, millions and millions of new jobs have been created or recreated. But still, there are 4 or 5 million people, fewer people in the workforce now than there were 2 years ago. Some of them have retired, but some of them have just decided that they're not risking it. They're not going to go into the workforce because they don't want to catch COVID and die. And so the workforce is lacking 4 or 5 million people. And so that's shifted the balance between capital and labor for the first time since globalization started. Labor, the share of the profits going to the labor force, has been shrinking for decades because corporations have shifted their manufacturing to low-wage countries. So the profit margins, or the share of profits that go to capital or to corporations, has been very high. Profit margins have been extremely high because the share of the profits going to labor have shrunk and shrunk and shrunk. But now, because of globalization, which has the downward pressure on wage prices, has been one of the main reasons that we've seen such low levels of inflation before COVID. But now suddenly COVID has changed the balance. The power, temporarily at least, has shifted to labor. There's a shortage of people willing to work and risk getting sick, and the shortage is 4 or 5 million people. And so suddenly these people can demand higher wages. And so suddenly, for the first time in decades, they're getting a fair share of the deal. They're getting some upward, I think 4%. This is probably just going to be temporary because once, a lot of people have been receiving subsidies from the government in terms of stimulus checks that went straight into their bank account. Others have received extended unemployment benefits. There's been a moratorium on student loan payments that has been very helpful. And child support payments on a much higher level than ever before. But all of those things have either stopped or are about to stop. And that's going to push people back into the workforce. And as it does, as those 4 or 5 million, at least 3 or 4 of those 5 million people re-enter the workforce, the advantage they had from the labor shortage is going to evaporate. And once again, as globalization resumes, then this is very likely that their wages will stop going up. The median income for the American household was roughly flat since the early 1970s. And that's why we've had such discontent among so much of the American public and this sense of pessimism that we've changed from an era of high rates of growth and growing prosperity, every generation being richer than the previous one. That's not been true for the last 30 years. And that's really taken a toll on the American psyche. And that's, I think, led to this very bitter partisan divide that we're seeing in politics today.
Speaking on politics just for a second, one other thing that's been plaguing our economy as of late is the supply chain disruption that we've been seeing. And anecdotally, living here in California, I've heard something that I just found really interesting, which was essentially that we have a mandate here in California, let's say, where you can only stack a container too high, meaning 2x, in a storage yard. But if the law allowed for us to stack it 3 or 4x high, we would no longer have truck beds that have abandoned containers sitting on them, which means it would free up drivers to go pick up more containers and thus move more containers through the system. I'm just curious, that's just a California thing, perhaps, but how much are you seeing on the supply chain side that is either political or actual, disruption in other ways? Are you seeing something similar? Have you come across something similar? If Richard Duncan was president, what would you do to eliminate the supply chain headaches we're having?
In terms of regulation, we have to learn as we go. And every society does. If what you are saying is correct, and I'm sure it is, then adjustments need to be made. That doesn't mean that no regulation of any kind is required. For instance, it was under regulation of the banking system in the lead up to the crisis of 2008 that caused that disaster, which cost the government and therefore American taxpayers trillions of dollars. So we have to find the right balance. Sometimes there's too much regulation in certain industries and sometimes there's too little. I don't know about you, but I'd like for the pharmaceutical and medical industry to be very highly regulated because, people looking for profits can be bad. they will sell you bad drugs if they can. So we need to strike the right balance. But in terms of what needs to be done to overcome the supply chain bottlenecks here to the extent that we can, well, one thing that we can do, and thank goodness we are starting to do this, is we can invest more in American semiconductor industry. In fact, Congress has recently passed a law. I'd like to elaborate on a bit further later in the conversation. But that law includes $50 billion of investment in new American semiconductor manufacturing facilities. And of course, if you expand the amount of semiconductors that are manufactured, then prices will come down. So that government-funded investment is a very big step forward that will ensure security for the U.S., not only lower prices, but the ability for the U.S. to create its own semiconductor chips when it can't access them from other sources, as we've been experiencing to some extent over the last 2 years.
All right. So in our last conversation back in July, you explained how our government needs to continuously grow credit in order to grow the economy. Well, GDP increased 10% in 2021 to nearly $23 trillion. How much credit was needed for that increase?
Okay, so let me elaborate on that. What we have seen since money ceased to be backed by gold, up until 1968, there was a law that the Fed had to own gold to back every dollar that it created. But at that point, it didn't have enough gold to create any more money. So Congress changed the law and eliminated that requirement. And afterwards, a lot of things changed in the world. But one of the most important things that's changed is that credit exploded. And credit has grown. By total credit, what I mean is all the credit of the country. And since total credit is equal to total debt, this means the debt of the government debt, the household sector debt, the corporate debt, the financial sector debt, all the debt. It first went through $1 trillion in 1964. By 2007, it had expanded to $53 trillion. So a 53-fold increase in just 43 years. And now it's about $87 trillion. So it's gone up 45% since 2007. So our economy, because of this credit, proliferated to such an extent that it became the main driver of economic growth in the United States and therefore the world. In fact, anytime going back to 1952, anytime that credit has grown by less than 2%, and this is adjusted for inflation, the U.S. has gone into a recession. That happened 9 times between 1952 and 2009. And every time total credit grew by less than 2%, adjusted for inflation, the U.S. went into recession. And the recession didn't end until there was another very big surge of credit creation. So when I say that we need for our government to grow its credit to keep the economy growing, that is a true statement because the private sector is already so heavily indebted that it really can't take on enough debt to keep the economy growing. So you ask how the economy grew by 10% last year. And this is in nominal terms. Over the last 2 years, there's been a big surge in total credit. Total credit increased by $8 trillion in 2020, which was by far more than ever before. And that was driven by a $5 trillion increase in government debt. Last year, the credit didn't grow as much. It was something closer to pre-crisis levels at $5 trillion. So we've seen $13 trillion of credit growth over the last 2 years. That explains why nominal GDP grew by 10% last year. So in percent terms, I keep talking about we need 2% adjusted for inflation to stay out of recession. I call it the 2% recession threshold. So in 2020, total credit grew by $8 trillion. Before adjusting for inflation, that was 10.5%. But if you adjust for inflation, then in 2020, total credit grew by a whopping 9.3%. That was very much more than it had grown for a very, very long time. So that enormous surge in credit expansion in 2020 helped carry it over into 2021 and is probably still supporting the economy into 2022. But things slowed down in terms of credit growth last year. We don't have the fourth quarter number yet, but it looks like it will be about $5 trillion of credit growth for the full year, down from $8 trillion the year before. So that's 6% credit growth before adjusting for inflation. But because inflation was high last year, that's only 1.3% after adjusting for inflation. So that's well below the recession threshold. And this year, based on my estimates, looking ahead for how much credit is going to grow, it's not that hard to estimate how much credit will grow by. If you just forecast how much it's going to grow for the government and for the households and the corporate sector, that's most of it. There are only a few big sectors. You can make educated guesses. It looks like it's going to grow by something like maybe $5.5 trillion this year. But since the inflation rate, the average inflation rate for the year, if we assume that inflation is 4% on average for this year, then that's going to give us only 1.8% credit growth after adjusted for inflation. So we're looking at 2 years of credit growth below the 2% recession threshold. So we're on a credit high from 2020, when there was a very big surge of credit expansion driving everything. But now that credit surge is evaporating. And that's one reason the outlook for the economy is somewhat concerning, one of a number of reasons.
Concerning that credit is tapering off a little bit, but we're still not hitting your 2% threshold, correct? So what would it take to start going over that threshold?
It's going to happen this year that's going to take us above that threshold. It doesn't look like it's too late. We had 3 big rounds of government stimulus that supported the economy and that had to be funded by government borrowing, by increasing government debt. Those occurred in March 2020, in December 2020, and in March 2021, nearly a year ago. We're not going to get any more big surges in government stimulus. Fiscal stimulus, the last big dose of fiscal stimulus was in March 2021. There aren't going to be any more big doses of fiscal stimulus. So the fiscal stimulus is over, and there's nothing that's suddenly going to ramp up household sector borrowing in and of itself or corporate borrowing. In fact, now that the Fed's set to start hiking interest rates, as interest rates move higher, it's going to make it more expensive for people to borrow. So that's going to make it less likely that credit will expand. We're not only seeing that fiscal stimulus is over, we're also seeing that monetary stimulus is over. The Fed is suddenly and very abruptly switched from a very loose monetary policy to what's shaping up to be quite a tight monetary policy. It was only in November that the Fed said that it was going to begin slowing down the pace of quantitative easing. Up until then, it was creating $120 billion a month. It's then announced that it would slow that down by $15 billion a month. And only 1 month later, they doubled that, tapering to $30 billion a month. That means that the QE is going to end altogether by early March. So no more monetary stimulus from quantitative easing. And at the same time, the Fed has made it very clear that they expect to start hiking interest rates in March, and that they are going to hike interest rates a lot this year, and perhaps more than just 25 basis points each time, perhaps by 50 basis points. And then the final blow that really floored the stock market last month was on January 3rd. The Wall Street Journal reported that Fed officials had started talking about launching quantitative tightening. Quantitative tightening is the opposite from quantitative easing. Quantitative easing, the Fed creates money and injects it into the financial system by buying bonds. And the more money that gets injected into the financial system, the more liquidity there is, and the higher stock prices and other asset prices tend to go. But quantitative tightening is the opposite. With quantitative tightening, the Fed destroys dollars, and that removes liquidity from the financial markets. And that tends to drive the asset prices down again. It's like the liquidity is like the tide. When it goes up, all the asset prices float higher. When it goes down, they all tend to sink. So this came as a real shock to the stock market because the Fed hasn't even stopped quantitative easing yet. And now they're telling us that they're about to launch quantitative tightening sometime before the middle of this year, if things go as they look like they're going to go. So that's why the stock market between January 4th and January 27th, the S&P fell nearly 10% and NASDAQ fell nearly 15%, with most of the high-flying risky assets getting slammed much harder than that. We're looking at now the beginning of what could be quite a severe tightening cycle that occurs faster and more aggressive than the last tightening cycle. So that is likely to result in asset prices falling further before this tightening cycle eventually comes to an end. And so if asset prices fall, then that will destroy wealth, and that will be a negative wealth effect that also acts as a drag on the economy. So no more fiscal stimulus, a reversal of monetary stimulus. These are adding up to be really bad news for not only the economy, but for investors, especially those people investing in the most speculative asset classes.
Yeah, I'm curious if you believe if they're going to do that or not, mainly because, to your point, they've only continued to purchase assets since coming out with those statements. If you look at the balance sheet, it's only going up. There hasn't been any tapering, and we're getting closer and closer to March. So when you see that, it can lead you to a watch what they do, not what they say kind of narrative. Is the Fed at risk of losing credibility or even trustworthiness if they continue to say things and not follow through with them? I think in our last conversation, you even mentioned that it took them something like a year and a half before they actually started tapering when they first started the QE efforts back in 2008.
Well, you're right. So they are still creating more money every month, but they are creating less money every month. They are tapering. They are no longer creating $120 billion a month. It has ratcheted down very sharply, and it will end in early March, as they've said. The monetary policy is like a super tanker. You can't turn it on a dime. The Fed had led people to believe that quantitative tightening was only going to be reduced slowly starting in early 2022, and that quantitative easing would continue on all through 2022. But then suddenly in November, they started changing their messaging pretty abruptly. And what has in fact occurred is they started tapering several months earlier at a much faster pace than expected. And rather than QE going on through the end of the year, this year, it now is going to end in early March. People had expected this to go on until the end of the year. They had expected more and more money creation until the end of this year. And investors had placed their bets accordingly. They had bet because the Fed had told them that there was going to be more and more money creation this year until the end of the year. But suddenly the Fed is sending out a different message now. They're saying the money creation is going to stop in March. They tried to spin the supertanker around too quickly. And that's why we got the stock market sell-off in January. Now, it's interesting that in the past, for really going back to 2008, every time the stock market started to have a significant correction, the Fed would do something to try to support the stock market again. They call this the Fed put. In other words, in the fourth quarter of 2018, there was a pretty big stock market sell-off in the fourth quarter. And at that point, that's when the Fed put monetary policy tightening on hold. They stopped hiking interest rates. They said they were going to stop quantitative tightening, and they did. So every time the stock market wobbled between 2008 and really essentially up until the end of last year, the Fed would do something to push it back up again. This was called the Fed put. So it made sense to buy all the dips because you knew the Fed had your back. The Fed put may not exist any longer. The Fed needed asset prices to go up after 2008 because credit growth was extremely weak. It wasn't strong enough to drive the economy. It was just barely above the 2% recession threshold. So the Fed orchestrated higher asset prices to create a wealth effect. And that wealth effect allowed more consumption, and more consumption drove the economy. So between 2007 and the end of last year, the wealth of the household sector doubled to $145 trillion as a result of this Fed policy. The Fed needed stock prices to go higher to create this wealth and drive the economy because credit growth was too weak to drive the economy. But that's not the situation we're in now. Last year, the US economy, real GDP growth after adjusting for inflation was 5.7%. That was the highest economic growth in 37 years. And so from the Fed's point of view, the economy is growing very rapidly now, plus inflation is too high. So they don't need more asset price inflation. And so they may tolerate a significant correction in asset prices this time, particularly in the things they disapprove of most, meme stocks, for instance, or the other high-flying NASDAQ stocks. They don't have to have the asset price inflation now, they think, to support the economic growth. And in fact, if people lose some wealth, that may put downward pressure on inflation, which would be a good thing from their point of view. So be a costly error this time to buy the dips. The Fed may not have your back. We'll have to see.